So now more than ever, I'm being asked, Lamont, what is life insurance? What's going on? What is the trend going on right now? I'm seeing it all over the internet. People are constantly talking to me about this. I have coverage. I don't know what I have. I'm hearing there's new versions of it. What can it be used for? Folks, it's real. We're living in a society where now more than ever, we got to think about protecting our income. You look at the economy, one day good, one day not so good. We're at war right now. Prices are going up, cost of living is going up. Things are getting really out of control if you think about it. So now more than ever, having coverage and protection on your family's income is vital. And I want you to be equipped with at least the basics. So when you go and entertain the option of either upgrading your current life insurance program to something more modern, something more useful, or going to get insurance for the first time, I want you to know what to do, how to talk the talk and walk the walk. So that's what today's going to be about. Now, what you need to consider off the bat, no matter what the type of life insurance, they fall into two categories. That's right, two categories. The first one is temporary, right? And it means just that. You get life insurance for a set amount of time, typically a couple of years, 10, 20, or 30. And then the second type of coverage is permanent, right? This is coverage that lasts your entire lifespan. So let's take a look at what that means in a little more detail. But before we jump into it, I want to talk about what life insurance can be used for, right? When you think about the solutions life insurance can provide, this is a program that's been around for over 100 years. People have been using life insurance for what it does and not what it is. Remember, most people that don't know about life insurance only know that it covers the family after a person passes away. But what they do not know is that there are a tremendous amount of benefits within life insurance that can cater to different needs of our life. For example, let's talk about what life insurance could be used for when it comes to temporary insurance. That's right, term coverage. The first thing that everybody knows, like I said, it replaces your income at the time of death. But did you know that the more modern versions allow you to protect your income if your health declined? That's right. If you got diagnosed with a critical, chronic, or terminal illness, term insurance now has modern versions that can allow you to pull money from the insurance and cut yourself a check. That's right. Think about how many people are out there super sick or just got sick and don't have enough funds to get healthy, right? Their jobs are putting pressure on them to get back to work because the coverage for illness runs out and employers are stressing you out. What if you had a check coming to you that allow you to heal the proper way? And what if you could use these monies not to be a burden on your loved ones? That's why the modernization of term insurance was created. When you think about using term insurance to cover debt that has a finite date, a debt that's going to end. For example, if you're buying a home, it's very intelligent to get term insurance to cover the mortgage. Obviously, you don't want your family to have to move out of the house. God forbid you passed away within the time of that contract, right? Also, other types of debt that you know are going to have an end date. The last thing you want to do is transfer debt to your family and be a liability. So term insurance is a great way to solve that need in your family's future. Also, secure your insurability while conditions are good. Many people may not need permanent protection on their income, but they also want to make sure that at least they have something, God forbid something happens. As we know, most of the time as we get more senior, our health declines. So the earlier you could get some type of life insurance, not only can you keep costs down, but you can make sure that later on, some programs have the ability to be converted to a permanent format. And now you can have the same type of health rating that when you were young, converting the temporary coverage to a permanent. Don't miss that. There's a lot of portability when it comes to term, depending on the company. Now, the last thing I want to talk to you about is many people purchase term insurance because you can get a lot of insurance for a cost-efficient price. And this is a big deal when you're actually in your years with the most responsibilities, right? You have a home, you have a family, you have a business, all these things that your family depends on. And if God forbid you fail during these times, what will happen to them? Right? A nice amount of term coverage could really revolutionize a family's last name. And it also gives you peace of mind while you're out there going after it. Everybody has a dream to get wealthy and do right by themselves. How much peace of mind would you have knowing that if you didn't make it to those goals and you graduated this lifetime, there was some income left behind to allow your family last name to move forward? Right? And when you talk about permanent coverage, right, this is the one that's really, really impactful when it comes to leverage, right? Being able to use it as a tool, not just to replace income at the time of death, but you can also add riders to it to cover your health, right? Critical, chronic, and terminal illness can be added to the permanent life insurance that covers your income, your family's income for your entire life. Right? You can also use the savings within this program to set up a child savings program. Some companies allow you to apply for children 2 weeks out of the womb. Could you imagine compound interest affecting your children's income for the rest of their life because you made a decision to start saving money in this powerful tool? You can also use the savings within permanent coverage as an emergency fund. As we know today, many families are a few paychecks away from being in a lot of trouble. A big emergency comes around and most people go into debt. If you were to qualify for a permanent life insurance program, you can have a bucket of money accessible to you when you need it, especially when those big emergencies come, because they don't call in advance. We all know emergencies don't call in advance. You should also think about supplementing your retirement income with permanent life insurance. Why do I say that? Most permanent life insurances have interest rates in a contractual way, meaning that money's gonna be there, right? If you fund it properly, money will be there for you. And then most people also have retirement programs that have a lot of risks. For example, 401ks and IRAs, they go up and down with the market. So let's say you go to retire next year and the market does negatively. That retirement program that you have through your employer may not have the same amount of funds that you thought you were gonna have. So supplementing that by funding a permanent life insurance program can allow you to create another income stream for you and your family. Think about how many people need to know that. And then last but not least, intelligent people use the savings that they acquire within life insurance to leverage it and use and get other investments. That's right. So let's say the stock market goes down. You have a sufficient amount of income inside of your permanent life insurance. You can go and buy those stocks for the cheap. And now when the stock market comes up, you got 2 buckets of money. Or you're walking around and you see a property and you say, hey, I can make money with this property. You can go and take the money from your life insurance, purchase that property, and now you have 2 income streams going on at the same time. You could take the money that you made on the investment property and pay yourself back. Many people in society who know about permanent life insurance have been using it as a bank. That's right. If you look at the stats, many of the banking institutions put tons of money inside life insurance. Not because banks are going to die, it's because these monies have more guarantees on them, more so than the bank. Think about where you have your money today. Is it just sitting somewhere that's not gaining any interest? This is definitely a strategy that you can use to take your family to another level. So now that we know some of the things that can be done with life insurance, let's talk about how much you need. So many families are walking around here underinsured, some people even overinsured. I ask people all the time, how did you come up with this number of life insurance coverage? They go, I don't know. Somebody just said it is what it is. You no longer have to be that person. A simple format to figure out how much life insurance coverage you need is called DIME. That's right, D-I-M-E. And it tells a person how much coverage do you actually need. So when you think about the letter D in DIME, how much debt do you have outside of your mortgage, especially debt that can be transferred to your loved ones, God forbid you left this earth. You want to enter that number where it says debt. Then you want to think about your income, right? It's bad enough that a human being is lost in the family when a person passes away. But what if that person is the main breadwinner? How would that income loss affect the sustainability of that family? So when you think about your income that you want to cover, God forbid you're not here, most of the times we recommend thinking about 10xing that, right? Multiplying your annual income by 10 years. Because think about it. Here you are, the breadwinner of your family. For some reason, you didn't wake up the next day, and now your family's scrambling. Or you got just enough life insurance coverage to help them out for a year or two. Nobody that's in charge of their family will want to see their family become a burden to somebody else. And we're seeing this a lot in our society today because people are not planning properly. So multiply your income times 10 and put that in that line. Now, for my homeowners, everybody knows the bank will take that house back if that mortgage is not paid. So you want to put the balance of whatever your mortgage is there to make sure that that's covered in addition to the monies that you're going to leave behind. And then the E's for education. If you have children and you want to contribute to their education, God forbid you're not here, you want to total up those numbers as well. Typically in America today, a formal education per child is about $40,000. That's right, $40,000 if you're going to a certain type of school. Obviously, the better the school, that number goes up, but around 40K is a number that you want to think about, right? You add up those totals and now think about how much insurance you have in place. Most people have insurance through their employer. And what that looks like is typically 1 year of your annual salary or maybe 2 at most. Think about how long that's going to last your family. Another thing is you want to ask your employer if that insurance can stay with you. Because at the end of the day, if you're not planning on marrying your employer, the day you separate, you might not have certain benefits. So I suggest if you do have coverage through your employer, go to HR and ask them how portable that is. Does that stay with you if you're going to separate? Chances are many times it doesn't. I've had clients that got fired 30 years in their career and then had to apply as a senior for life insurance. Don't let that be you. Right? So you want to subtract any coverage that you do have in place. I wouldn't even count the amount from your job unless you necessarily have to. The goal is for you and your family to set up systems outside of your employer, things that you control. All you got to focus on is getting income, but you have your own financial systems. And that's the beginning of financial freedom is you being in control of the situation. So now that you know how much you need to get when it comes to life insurance, let's talk about the different types, right? And this is just a little history lesson for those of you that don't know, but the first form of life insurance coverage is called whole life. And this was created over 100 years ago. Historically, it was the most pricey of all the insurance programs around. So only a certain segment of the population was able to afford whole life, right? So you see the $3 signs there. When you talk about the savings component of whole life insurance, depending on the company, they give you 2 to 3% interest on your money. So your money's growing on average about 2 to 3% inside of it. Now, this is a positive because at least you get something year after year, but it's an area of concern because now you want to think about, is that money outpacing the cost of living? And that's vital when you're talking about saving money anywhere, because if the interest that's growing on your money is not higher than the cost of living, which folks at the time of this recording, the cost of living is at 7%. That's right. Every year the dollar's going down 7%, which is a lot. So if your money's not outpacing 7%, your money's safely dying. You want to think about that when it comes to any investment. But that's typically the industry standard when it comes to whole life permanent coverage, 2 to 3% interest on your savings. When you go to borrow money from this program, the loan provisions usually charge you around 3 to 7%. So you want to keep that in mind. But like I said, because this is so costly and it doesn't have a lot of flexibility, The main problem was the cost. So the industry had to make another offering for the public. It's like every other industry, supply and demand. The consumers say, hey, we don't want to pay so much for life insurance. So term insurance came about. That's right, temporary coverage. Like I told you earlier, it's cost effective. You can get a whole lot of insurance for less dollars, okay? The only thing is you can't grow any money inside of it. There's no savings element. So you can't borrow from term insurance. And like I told you earlier, the contract rates vary anywhere from 10, 20 to 30 years. Now, it's good to know these things and always take a review of your policy, because if you live a day after these contracts, no more coverage is in effect. That's right. So if you have a 30-year program and for some reason you didn't convert it, if it's allowed to be converted to a permanent program, on that 30th year and a day, that's it. No more life insurance for your family. And that's a challenge because now you're 30 years more senior. And as we get more senior, the cost goes up in life insurance. So people were like, you know what? We need permanent coverage, but we don't want to pay a lot of money. And that's when universal life came about. Universal life was the first type of permanent coverage that was cost effective. And with that reduction in cost, also lowered the interest rate given on the savings component. So as you can see here, the interest rate, depending on the company, is either 1% to 2%, which is very low. Like I told you before, low interest is an area of concern when it comes to savings because the cost of living keeps going up, right? The loan provision also got reduced, right? They're trying to keep costs down with this program. It does have positives though. Sometimes people get universal life coverage because they just want a steady program of insurance for permanent situations. We also call it like a permanent version of term insurance. Cost effective, but lasts you your entire life, okay? But because the earnings inside of it was rather low, the industry said, you know what, we're gonna make another evolution of life insurance. And what they did was they created variable universal life. This is a form of permanent coverage that's cost effective, but the savings inside of it is tied to the stock market. That's right. For those of you who enjoy the highs and have to take the lows, that's what you get with this program. Market goes up, your savings goes up. Market comes down, you know what happens. You lose money. Some people enjoy it, some people don't, but it's a solution that's out there. The loan provision on this program is usually 2 to 3%, depending on the company. But folks, some people were like, look, we like the fact that it's cost effective, but we really don't like the fact that we're losing money. I never heard a human being say, I enjoy losing money. So the industry made another upgrade to permanent life insurance called Index Universal Life. Now, this is permanent protection, right? This insurance lasts your entire life as long as you fund it correctly. It's cost effective, but now you get to go with the upside of the market to a certain extent, and you get protection when the market goes negatively. That's right. You don't lose any money in this program because they give you a floor, and then you can go up to a certain cap. This is by contract based on the company. This is an evolution. Some companies allow you to go up as high as 25% interest. Could you imagine if your money went up 25% and when the market does well, and when the market doesn't do so hot, your money stays the same? Some companies even give you a positive interest rate when the market does negative. So while everybody else has their money losing in programs and open to the market 100%, this is something that you can use to make sure your serious money is protected. The loan provisions even got reformed, right? So when you look at the first 10 years, if you borrow from this policy within the first 10 years, most companies are going to charge you 2 to 2.5% interest on that money. But if you wait till the 11th year to borrow, most companies give you a 2% credit. That's right. They give you credit for waiting longer to borrow from the program. Strategy, guys. At that point, you're only paying cents on the dollar, whereas most banks are really going after people with interest rates going up these days. So these are the different types. They all have different solutions that they provide, and they can be used at different points in your life or a combination of. The question is, what position are you in life? Which of these makes the most sense to you? And now you can have an educated conversation with whoever you choose to help you acquire or upgrade your current coverage. The last thing that I want to speak to you about is, how do you qualify for life insurance? Most people are afraid to even apply. Well, take a look, folks. These are the main areas that companies look at when they think about giving you an opportunity to acquire life insurance. The main thing, the first thing, is your health and your age, right? There's something called a MIB, which is the Medical Investigation Bureau, Insurance Bureau records, which basically means that they're going to run your health records. So anything that a doctor put on your records, they're probably going to find it. So you need to be very transparent with a person who's trying to help you to get coverage so that they can send you to the right carrier. Not all carriers are the same. Each carrier has their own underwriting and approval process. So you want to be very transparent of any medications that are on your record. I didn't say what you're taking. I'm saying what's on your record, because it will come up. Also, your driving record, right? Most companies are looking for DUIs, any arrests, any suspensions of licenses. They're going to be, this will come up. They're going to run a record of that and ask for information regarding your driving record. Your criminal background, right? Felonies, how long ago, what happened, what was it for? Every company's different, so don't be afraid to apply. Just be transparent with your agent so that they can shop around and partner you with the best company. The last but very important form of the consideration is your financial suitability. Life insurance companies want to make sure that you can keep this agreement, because for the most part, it's a significant time that you want to be involved in this contract. So they want to make sure that the money that you're using to fund this program is not going to put you in a hardship. And as your agent should also be aware of this as a fiduciary, making sure that you are getting in the best program for the situation in your life. I've had clients that their budgets were not that high, so we were able to get them some low-cost term insurance to protect their family while they were getting more income in their life. And then once the income came about, we converted it to a permanent program. So I strongly suggest that you think about where you are in life and understand your needs and try to create the right solution for you. I hope this information was useful for you. Please follow me on social media. This is going to be a long-term commitment to adding value to you, the public. I love helping people. I love showing people the ropes when it comes to making money, saving money, protecting money, and growing money. At the end of the day, these are my social media handles. You have someone you can trust. Let's win big for our families. No family left behind is the motto. Please look at your current life insurance policies. If you don't have any, let's talk strategy. I'll talk to you guys later. Have a blessed one.